live, Jeff.
All right. Hey, everybody. Chef Gibby here. Thank you for coming to the market recap. I hope you're doing well. It's been an interesting week. I'm interested to talk to you about it with our guest. Let's go ahead and read the legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So there you go. Today we have a very, very special guest. I'm going to go ahead and bring him on here. A guy by the name of Price Headley. And Price Headley runs bigtrends.com. One of the things, I just love Price. One of the things about Price is he's one of the very, very first people I created a plugin with as a business development guy here at MetaStock. And I just remember I've learned a lot. I like a lot of, I always say this about your Price, but I like the way you like to talk about, finding the best opportunities and ignoring stuff that doesn't make sense. And I, more than probably anybody, just based on where you fall into where we started working together in my career, I consider you a mentor. So thanks for coming on.
Well, thank you, Jeff. I consider you a great friend, and you've certainly been a pleasure to work with over many, many years. So, and you've helped me with multiple upgrades to our Big Trends toolkit for MetaStock. So thank you for that. And always exciting, especially now with what's going on in the market, to talk with you about how the charts look in MetaStock.
I always kind of start a little bit with like how did you actually get involved in stock trading, Price? I'm very curious to know.
Well, I'm from Kentucky. My family's been in the thoroughbred horse business for generations, and so I was at Duke University and studying to be an equine veterinarian, and instead basically got into the stock trading contest. And was exciting and did really well in it, and told my dad I was going to do something more conservative than breeding thoroughbred horses. I was going to trade stocks and options. And so he thought I was nuts, but as long as I stayed on the 4-year plan to graduate from Duke in the allotted time, I was able to switch majors and did so. And then it was just knew what I wanted to do from there. I just basically got the trading and investing bug. And this was the late 80s, so it was right after the 87 crash. And it was just it was a time where I was taking the Warren Buffett approach the first bit of the contest. It wasn't working. And I started just actively trading every day out of the journal. It was paper money at the time before I started doing real money, not long after that. But the reality was it just really instilled that passion and interest for me in the markets. And as a result, allowed me to really just know what my course was from there.
Awesome. So what do you?
And I've got my little one running in too here. So
I saw a little tap on the shoulder there.
I'm talking to some friends.
We should say hi.
You want to say hi? Yeah. Okay. She needs some tissue. Okay. Well, here I don't have one. Go see mommy. She'll get you one.
All right.
Sorry about that. Okay.
What do you think about these markets?
I mean, it's been a phenomenal bull market. It's been a market that really continues to, defy the expectations. And at the same time, we're getting a corrective period right now where essentially the markets are due for this correction. We've had such a steady run to the upside that people forget sometimes that corrections are normal and healthy. And so I think the big thing is to keep in mind, what the general structure is of the market. So a lot of, like when we look at this chart here of the S&P 500, you can see here that it's essentially a market that's been due for a correction for quite a while. And so from this perspective, you get a situation here in which you really see that this correction we had on Monday, this pullback, when the first news that this was starting to get a little more serious over on the China coronavirus situation here, you saw that low was 322.66. And then today we closed 322.25. So technically that's a violation at the close today of what should have been a retest that should have held along the way here. So from this perspective, you see where you really have to be in a mode of realizing that, okay, now we're getting a little bit of a breakage in the trend. It had been very nicely overbought. And a lot of what we teach at Big Trends is that overbought period gets very powerful and very good until it's not overbought anymore. And now essentially we've come out of the overbought range and we've dropped below that low. That doesn't mean we're bearish now. It just means we're out of that current uptrend signal. And so that's basically when you look at any of the big names out there. Of course, one of the biggest would be Apple as it relates to how that stock has really driven the market to the upside. And so look at Apple.o here and say, clearly Apple is in a mode here where, it's led the market. It had its own version of a retest here on the Monday low. It did not break at the close. So in comparison to the S&P, Apple's still hanging in there off of a low in our work at 304.88. And you see today it closed in the neighborhood of about 309.5. So it's still acting better. And that would be our new stop now would be this next retracement retest on the percent R. That's the Larry Williams percent range indicator under that overbought 80 percentile threshold. So now we tighten our stop to say a close under 308.29 would get us out of Apple. And remember, if you think back to how long Apple's been on this roll, it's been on a roll for quite a while. So that when we go back and we look at, okay, how's this trend done for you? If you just follow the rules, this trend has done phenomenally for you, where basically the breakout in Apple was happening back here in early October in the neighborhood of about 227. The stock's now 309. So you have to have a perspective. Yes, we've had multiple test points in that trend, like the early December pullback that low. I told people it was a good buying opportunity as long as it held 256.29 on that low. And you say, okay, you just keep on following this system. And what it does, as you mentioned, Jeff, is it allows you to stay with the big trends. And then if it's not a big trend, you just get rid of it, whether it's a small gain or small loss, and move on. As I always preach, we want the big fish, then the big trends, and we want to leave the little trends to everybody else. So the goal for your money to grow well is to be in the leaders, to be in the names that are really in that trend phase. But when they end, you do not fall in love with that name just because it made you a bunch of money. Say now that trend is ending. We're not there yet on Apple, but we are there on the S&P, and of course with the NASDAQ. If you looked at the QQQs the same way, of course, they are heavily influenced by Apple. They're still hanging in there, but right now we'd not be using today's low, since that was a slight retest under 218 on the Qs. Same kind of trend as Apple, really, because Apple's such a big part of that. But if you compare that to, say, the Dow, where of course it has Apple in it, but not the same type of weight as a lot of the other averages like the QQQs, that's already broken down here. Certainly the retracement on Monday as a key low on the DIA was at 283.86, and today we closed 283 even. So that's a breakage, just like the S&P, to say, okay, we're going to back off on that. And then the other indicator that I've pulled up on here that I think is really interesting is, and you helped me, Jeff, so much to develop this, is the big trend score. And the big trend score is something I use on a lot of the individual stocks. I don't use it so much on the indexes because it's one of those that's really geared at telling you if you go overbought in the top 20% of readings here, it has the potential for a big trend. Usually on the indexes like the Dow, you can see it's actually kind of an end point of that move the last couple of times it hit up there. If you compare it to, say, Apple, and we should look at some other names here, of course, but the point being that if you looked at Apple and said the big trend score factors in all the indicators that I've looked at over my 20 years since starting Big Trends and 30 years in the trading game, and saying, okay, when it's staying in that top 20% of readings, that's going to be your best trend phases. There was one, and then this one really kicked off here right around just before Christmas, and the stock roared to the upside. But you can see the deterioration here in the big trend score just in the last week and a half or two. And look at what Apple's doing. It's starting to go sideways to a little bit lower, and that's right after the great earnings. Right, everybody's raving about what a super earnings report they had. Turns out it doesn't matter if the earnings are good if the rest of the market is starting to sour, or in this case, just the underlying trend indicators are starting to get a little more mixed, or maybe just maybe a moderate positive right now above this zero line. So it just tells us that, okay, it's one of those that we really want to, especially since I trade a lot of options, I really want to get the best phases of the trend working for me if I'm going to buy an option. You can't afford to be on a slow boat. You have to be on more of the speed boat when it comes to options buying. I know a lot of people in options have gravitated to just selling options, which is really a challenge when you think about, some of the indicators out there like the CBOE volatility index, or any of these other volatility measures. If you look at VIXY would be another vehicle like that you see like that the volatility has been so low, it's finally getting a little pop up, but you can see essentially we're in this environment where volatility has been low. That's a great time to be buying options and not such a great time to be a premium seller, especially when you get the directional trends that we've had in a lot of the big tech names. If you look to say, of course, one of the ones that everybody has finally caught on to is the semiconductors. They've gotten pounded here over the last week with this market sell-off, or maybe a better example might just be, say, the tech sector as a whole, say XLK technology, where you say, okay, these are vehicles that, have been just steadily climbing until just the last few days, really. And you just see how powerful that uptrend phase is when everything goes overbought. You want to be riding that trend. You don't want to be day trading this stuff. This is a daily chart where we're riding it for sometimes weeks, even as an option trader. So because of course your leverage really piles on. So anyway, long story short, I'm still bullish in the big picture. It's just that in the very short term, this is an end to the really great trend phase, and therefore you've got to adjust accordingly.
It seems a little bit it seems a little bit more serious than it has been, the corrections that we've had in the past to me. What can I ask you, what are you going to be kind of watching as we go into next week to kind of confirm a bias that maybe the trend is over, or maybe that what are you going to be kind of paying attention to next week?
Yeah, I mean, obviously, you can go from a daily time frame and you can go look at, say, a weekly time frame, for example, and get some additional perspective on the %R, the big trends indicators. And, big trend score is still very positive. So even though, yes, the fear is there, it's starting to heat up, we started to see the volatility rise, and that's what you want to see. You want to get people worried. I'm looking for actually that we could actually get a quicker and harder flush on the downside to start off the week, and then see how the market reacts to some kind of a hard sell-off. I think it would be the best thing for the bull market if you could actually get a hard flush on the downside and see the market then recover from it. Because the other thing you've got to watch is what's happening with the competing sort of flight to safety vehicles. If you're looking at the gold market, for example, you would expect that the flight to safety money should be moving into gold. And it is. It's been a little slower than I would have anticipated. This is the weekly chart on gold. It has cleared through this last high there, which was just under 147. Now we close today at 149. So I do like gold. I was preaching gold when we had this pullback into the start of the fourth quarter. I was saying this is actually a nice little retest area to buy into. You can see it when you look back on the charts, that the retest areas a lot of times, as long as you have a little patience, as long as they don't break down, they can stay flat for a little bit around that support. But you get some really nice entry points into those retracement retests. But of course, the best phase would be if we're going into that really strong big trend score phase like we saw June through August for the gold market this past year. And then, of course, the bond market. If you look at TLT, there's another good guide as to how much the flight to safety money is moving in, and it is moving in. You can see it started to really pop back up here over the past couple of weeks. But the thing is, Jeff, is that I don't see a really strong case to be made for a huge stock market bear market for a while, especially if the bond market is going to stay this strong. If the bond market stays this strong, remember, if bonds are going up, that means bond yields are going down. So we've got mortgage rates at 3-year lows. You've got no real pressure on an interest rate side. Of course, we know the Fed is supporting the market, even though this past week they didn't do anything. Not doing anything in the midst of a strong economic recovery with unemployment at 50-year lows is actually really good news for equity investors, because it means that you don't have the Fed trying to pop up quote unquote bubble. You have the Fed supporting the market. Of course, we're in an election year. Election years actually tend to be more volatile. They don't tend to be the straight up that you might think. Because the markets are kind of trying to assess right now especially with all the impeachment overhang, even though I think a lot of that impeachment news is not really that big of an issue for Wall Street. I think that what Wall Street is just trying to make sure of is, okay, are they going to have a pro-business candidate that gets reelected in November? Or the Wall Street's worry is, do we get somebody who's not pro-business? I won't name names on the other side, but basically just saying, that, I think that would be Wall Street's bigger worry, is if they viewed that there would not be a reelection pending, but rather a change of the guard, where maybe that might lead to some extra volatility as we head into the summer and fall. I don't think we're going to get it, though, until we get closer to the election. So my point is, I think there's still some really good money to be made while interest rates are low. You're getting a lot of, new housing activity. The housing stocks, if you look at a DH Horton, which is one we made some money on this past week, DR Horton, I should say, DHI is a symbol. You look at these charts and you go, what's not to like? I mean, it's just in a steady uptrend. You've had a couple of retests that have held really nicely. This little market correction is probably going to create a buying opportunity next week for some of these home builders, because rates are low and they're going to keep on rolling in terms of activity, in my view. So that's an example of maybe a less, most people are talking about Apple or Microsoft, which of course had great earnings this past week as well. Most people are talking about those names, but my take would be maybe go with some of the less conventional, less talked about sectors that are still rolling along quite nicely, like the home builders. So to me, that's a good way to think how you can maybe get a little bit less volatility in your portfolio and also get still quite good upside in names that maybe haven't been expected to keep on rolling, like housing and home building.
Awesome. That's really, really good. We're not getting a lot of questions through YouTube. That was really, really enlightening. I really appreciate you coming in.
Oh, yeah. Can I mention one other thing, Jeff, real quick?
Of course. I didn't mean to. I'm not trying to cut you out and chase you
you're
off.
Fine. If there was a concern that I have, because I don't want to be a Pollyanna, just perma bull, is that if you look at other certain indexes, like say the small cap averages, like the Russell 2000 IWM, you look at IWM and you say, you know what, IWM is really not participating in terms of breaking out the new highs, compared to this high. This is the weekly chart back to, August of 2018. We're still well under that high, about 173, and it's really acted badly in this correction over the past couple of weeks from the peak, where essentially what that makes me worry about is how broad-based is the market, bull market, if you will, on the upside. So to me, when I see that, even though it does look like kind of the classic percent R retest I was just mentioning, it doesn't look like as strong of a broad-based move. So when you think about where the opportunity is, it still looks like it's in the larger cap, bigger names, where maybe the institutions are kind of crowding in there because they're so liquid and they're so active. And even there, you've got to be careful because, like Facebook, for example, had an earnings report that was not well received this past week, even though Amazon blew the doors off, if you think about the FANG names, and say, okay, just trying to see what, for some reason my connection here is a little bit spottier, I guess, but basically saying, depending on what you're looking at, you've got to realize that the markets are going to be probably still very selective in the big cap space. So just remember that and say, okay, don't try to get too cute and buy something that is, quote, lagged. My approach always is to follow the leader, follow what's working, and then still it's mainly the big cap names, whether you look at the Dow, which is a little bit stronger than the Russell, but still not as strong as, say, the NASDAQ. So anyway, long story short, stay focused on what's working, stay focused on what the institutions are still buying, and I think that's going to still keep you well positioned to be in things that can make you money in 2020.
That was great. I have nothing else to add.
Thank you, Jeff. I appreciate you having me.
No, it was great. Thanks for coming. And always good to have you, Chris. We'll see you again soon. And for everybody that's watching, thanks for coming. I hope you enjoyed it. And we'll see you at the next one. Thanks, Bryce.
Thanks, Jeff.